Saludamos ya a Arnaud Mounier, es jefe de desarrollo de negocios de renta fija en Alliancebernstein. Hello.
Hello, thank you for having me.
Thank you very much for being with us today. Fixed income markets have had a rocky start on this year, on this 2025. So far, how do you explain that? And is it the sign of more difficult times to come for fixed income?
Well, I would explain it quite simply by, I would say, stronger than expected growth in the US, especially as evidenced by the good numbers on the job market. And obviously some anticipation of the Trump policies that are perceived as very pro-growth and also as inflationary and probably digging further the deficit. Now, as illustrated by the rally in yields yesterday that we saw across developed market, we see that the market is very jumpy and volatile, and it should remain so. The reality is now that we don't have a lot of forward guidance by central banks. They remain very data dependent. And so we should learn to live with this type of volatility. That being said, we don't think it's necessarily a bad thing for fixed income investors. It provides them with better entry points. And when we look at the absolute yield that you get now for government bonds or strong quality corporate bonds, then it's still fairly attractive when you compare what you get now versus what we would get maybe 3 or 4 years ago.
And what are your clients doing now in this environment, and what is in Alliancebernstein recommending now, especially to investors who have been sitting on cash for most of the past year?
Right. So look, recommendation number one is don't focus too much on the short-term noise. As we said, it's going to remain volatile. If you take more of a medium to longer term horizon, 12 to 18 months, and if you think like we do at Alliancebernstein that rates are going to go lower from the current level, especially because growth, when you look in Europe, is not very exciting, then you should have a good total return experience with fixed income. The recommendation number two that we have, especially for investors who stayed in cash, is really to look at the yields you get on bonds now versus the inflation rate that has decreased a lot. So what we call the real yields are much more attractive now than what they were 2 years ago. An interesting also fact is that the yield curve, whether it's in Europe or in the US, is no longer inverted. So it pays more to be investing in longer dated bonds than just to leave your cash in short-term deposit. And as we think that the ECB is going to cut rates further in 2025, 4 times, 5 times, then this differential between cash deposit rates, and the yield that you will get on longer dated bond is going to increase even further. So definitely a good time to leave cash and to jump into longer dated bonds, in our opinion.
Credit markets, for the next questions, they do look expensive given the sluggish economic outlook, especially in Europe. Is there more downside than upside in this juncture?
Look, it's fair to say that credit spreads are tight, but if you look by historical standard. Now you have to ask yourself, I would say, 2 questions. First one is it disconnected from the credit fundamental of these companies that you invest in? I.e., are you well paid, or are you paid fairly for the credit risk that you take, considering the credit fundamental? And in our opinion, for many of these companies, when we look at the fundamentals, meaning the leverage of these companies, the interest coverage of these companies, the margin that they have, we feel that the spread level is not that disconnected. Yes, we have seen some deterioration in credit fundamentals, but not in a dramatic way in most sectors. So we think it's not completely disconnected. The second question you have to ask yourself is, if you don't buy credit now, if you don't buy corporate bonds, what else do you buy? As we've just discussed, cash is not so interesting anymore. Equities will be quite volatile in this market environment, with the geopolitical tension still very strong. And typically, for instance, emerging markets valuations are not very exciting. So we think that just by staying in your European domestic market corporate bond is still a fairly decent opportunities despite those tight spreads.
And for Alliancebernstein, Arnaud, for the last question, what are the top risks for this year you are keeping an eye on, and how do you manage those risks?
Sure. Look, obviously, like everybody, we are going to observe the first weeks of the Trump administration, both from a geopolitical and an economic perspective. We have, even though people have been quite optimistic from an economic perspective, we cannot rule out the possibility of a hard landing in Europe, even in the US. Let's say with the policies in place, if they become very inflationary, the Fed cannot cut rates further, and then it becomes quite difficult for companies, difficult for consumers to get access to moderate cost financing. And so at some point that starts to create a problem for the economy, even in the US. So I would say the scenario of a hard landing is not a base case scenario, but it's not one that you can rule out yet. So to manage this, in our opinion, the best way to do it when it comes to fixed income is really to balance duration, increase your duration through government bonds, through quality bonds, and then take some credit risk, corporate bonds, strong high yield quality bonds. And by balancing those two together, in most scenarios, you should have a quite positive outcome.
Arnaud Mounier, jefe de desarrollo de negocios de renta fija en Alliancebernstein. Thank you very much for being with us this afternoon.
Gracias.